Do you get a scare when you saw the title of the video? The day you can look at the markets and your portfolio performance without much emotions is the day you become a true investor. But of course, this is provided that you know what you are doing for your portfolio so that any losses that you see are only going to be temporary paper losses. Before we get down to our portfolio performance, let's take a look at some of the key events that happened in the market in the third quarter of the year. First, we have the regulatory actions in China and the drive towards common prosperity. We saw how the technology sector was slammed with anti-monopoly regulations. The companies in the gig economy were asked to enforce better working conditions, and the profit-making private tuition companies were banned. Then there was further uncertainty arising from the property developer Evergrande. In our recent live Zoom Market Outlook session, we also shared that we should read the news media articles with a pinch of salt, as news have the tendency to over-exaggerate events. What the news media are after are the viewerships and eyeballs. That is their sole purpose. Their job is not to educate you and me to become better investors. There are many articles inducing fear in investors by playing with the usage of words on how the Evergrande event could become the next Lehman Brothers financial crisis for the world. Well, but if we take a closer look at the depths of Evergrande, we may have come to a different conclusion. The magnitude of the exposure that US banks have is much smaller as compared to the amount that we're looking at in Lehman Brothers' case. So in short, there were a lot of negativities surrounding the Chinese markets, including billionaire investor George Soros, who asserts that institutions or people investing in China is a big mistake. We also shared about our take on the endgame for China during the recent Zoom session. The Quad ETF, which measures the performance of the Chinese internet companies, has been down by about 50% from its high in 2021. China bulls, including Ray Dalio, Charlie Munger, who is Warren Buffett's right-hand man, Ken Fisher, and us, the joyful investors ourselves, all saw considerable paper losses in our portfolio with the historical sell-off. Our position for Alibaba and Tencent alone in one of our investing accounts is already running paper losses of 6 figures for now. However, this suggests our equity positions itself. We do have gains from the options trade which are not reflected here, which would help to lower our break-even point eventually. The Hang Seng Index has been down by about 20% from its high. The CCP is driven by control, so it has to make sure that businesses understand the important role that the government plays in the economy. But we believe the goal of the tighter regulations is not to destroy the businesses. And once the CCP has achieved its objective, it may be ready to gradually go into the shadows. The CCP seeks respects, but still values their large companies. Currently, the share prices of some Chinese companies like Alibaba and Tencent are not accurately reflecting the bullish thesis and strong fundamentals of these companies. So what we are experiencing right now is better termed as market inefficiency, which is caused by extreme investor sentiments. So following these policy changes, we believe that the Chinese tech companies offer a strengthened thesis and a favorable reward for those who are willing to take on the perceived risk of investing in China. Next, we believe it is in the interest of these private sectors to find the middle ground with the regulators. And again, we believe the goal of the CCP is not to destroy these private sectors because they are important to the China's economy. Without the support from the private sector, China will never be able to secure its position as a global economic powerhouse. Lastly, in my opinion, this may turn into a blessing in disguise. The crackdown has evolved into a wealth redistribution from the higher income to the lower income citizens. So this can quicken the pace of China achieving its dual circulation plan, which is for its domestic consumption to take the leading role, while international trade and investment remains its extension and supplement. If we look at how come China's economy can recover so fast during this pandemic, as compared to Singapore's slow economic recovery. That is because the consumption from China's domestic market is self-sufficient already. But for Singapore, we're heavily reliant on exports to boost our economy. So this wealth redistribution may actually benefit China's domestic market. In fact, some of these regulations are necessary and healthy for some of these industries that are affected. For example, the property developer industry, which has had excessive borrowings that are not healthy for the industry. No doubt, I think there will be more volatility in the short term because of all these regulations. But as an investor, I hold on to longer term views. We may not see the good portfolio results in 1 or 2 quarters, but it is the overall long-term performance that matters. And you can achieve that as long as you know that you are making the appropriate investments. Then, on the other side, the S&P 500 retraced slightly by about 5%, partly due to the Evergrande rules and partly due to the fear of tapering, in which the US Fed is expected to begin slowing down the bond purchases towards the end of the year. The Nasdaq was down slightly more, as we saw the 10-year Treasury yield has continued to rise since June this year. There were even articles mentioning that we are headed for some trouble that can really get investors freaking out. During our Q2 portfolio sharing, we have already mentioned that we should not be scared off by such news articles, as they are just market noises. What we should do is to stick to our investing rules by investing in only the quality companies, so that no matter what the market throws at us, we will still be able to perform well over the long run. In the short term, there will always be volatility. Prices of growth stocks may fall, and we're going to turn this into an opportunity to buy some of our favorite stocks, even if it means that your portfolio may not be performing as well in the short term. Because as investors, we always take on a longer term view to earn sustainable returns over the long term. So that's a roundup of the key events that happened in the recent quarter. If you wish to get more updates of our views on the market events, you can also follow us on our Telegram channel and Facebook page. We may also be holding live Zoom sessions from time to time to share about the market outlook and some investing tips. So how did our TGI portfolio perform the last quarter? In Q3 itself, we had paper losses of about $250,000, although we're still up by about 72k year to date. This translates to a drawdown of 17% for Q3, while we are on the whole still about 8.5% up year to date. This is the total return from both our Interactive Brokers and TD Ameritrade accounts. We took the wonderful opportunity to increase our existing stakes in the Chinese tech sector by almost 90% in Q3 on companies such as Alibaba, Tencent, Meituan, and JD.com. We did so by trimming the majority of our Singapore bank stocks in late April this year, as we felt that the run-up was getting unsustainable in the short term, and also by taking profits from some of our trades in the US markets as well. Bear in mind that this was against the backdrop of ongoing paper losses and all the negativity against the advice of renowned investors like George Soros, as shared earlier. Let's now take a look at how the major indices have performed. In the third quarter, we can say that almost the 3 major US indices remained pretty much unchanged. It went up initially in the early quarter, but eventually found its way back down towards the end of the quarter, giving up the gains for the whole quarter itself. And for the Chinese market, to better reflect our portfolio positions, which are mainly the Chinese tech, we use the QUAD ETF as a better benchmark to compare against. For Q3 alone, QUAD fell by about 34%. Now let's take a look at year-to-date performance. The 3 US indices have managed to garner about 12 to 16% so far, and our portfolio now stands at about 8.5%, slightly underperforming them. And again, as shared, this is due to the huge drawdowns arising from the Chinese market. R represents the portfolio return, RF represents the risk-free rate of return, and beta represents the systematic risk of a portfolio. RM is the market return per benchmark. So due to our extremely low portfolio beta, we still maintain a positive alpha for our portfolio. At this current juncture, with the considerable drawdown in the China markets, our Sortino and Sharpe ratio are 0.58 and 0.41 respectively. These numbers will improve once the China market recovers over time. Then, on the other hand, our mini portfolio still managed to beat the benchmark with a year-to-date ROI of 19.8%. And for Q3 alone, it was down by about 16.7%, as we are comparatively less concentrated in the China markets for this mini portfolio. What is the takeaway for this quarter especially? So why did this happen? Because President Xi did not follow our investing skill. Just kidding, for those who get the joke. Firstly, we need to understand the right investing concepts. Investors often associate falling prices with higher risk. When you get to buy a fundamentally strong stock at a steal, the downside risk is pretty much limited. Similarly, even a good stock bought at too high a price can be a risky venture. But most investors will label stocks in itself as either risky or not risky based on the rising or falling price levels. Just like how many investors deem stocks like Alibaba to be risky. For those who have been following us, you will know that in Q3 we were pretty much overweight in the Chinese stocks. At least 2/3 of our positions in the bigger portfolio were in the Chinese tech sector, and in particular on stocks such as Tencent, Alibaba, Meituan, and JD. The Quack ETF itself crashed by about 34% at the end of Q3, which inevitably led to significant drawdowns on our portfolio and wiping out some of the gains that we had in the first 2 quarters of the year. From its all-time high, the Quack ETF has retraced by more than 50% too. So, some of you may ask us, are we worried about this? The answer is no. We are not concerned about these unrealized losses, or what we call paper losses. We believe that our current portfolio is well positioned to ride on China's comeback in the years to come. In investing, it's about what you stand to gain and what you stand to lose. This strategic allocation we believe will pay off in time to come. Investing is not about making sure that you do well for a quarter, a month, or a week. You need more time than that for things to play out when putting your money to work. Equally important is to be patient. So few people succeed in the market because they judge their portfolio performance in a few weeks or months. They look to the stock market to get rich quickly, and they want to avoid stocks when it goes down. They only want to buy when the prices has mostly run up by a fair bit or almost at a possible top. This happened due to failing to analyze the sentiment of market participants and the need for instant gratification. Good stocks eventually appreciate sufficiently to make it worth the wait once the bull market happens. Over here at TJI, we are invested for the long term, and our time horizon for holding good stocks is at least 5 to 10 years. Investing is a marathon, it's not a sprint. Even good stocks have their seasons and fashions and go out of favor when conditions change. The current gyrations, no doubt, are pretty much more volatile if you were to compare to the US markets, and it is something to be expected when we invest in the China markets. While we may not be surprised if the China markets outperform the US in the next 5 to 10 years, we must also be equally calm when faced with the current drawdowns. This is because the China stocks are less fundamentally but more emotionally driven in the short term as compared to the more matured stock markets like the US, which are made up of more institutional investors. In the short term, it is the FUD that drives prices down, the fear, doubt, uncertainty, as portrayed by the financial media. So you can expect more irrational exuberance when it comes to panic selling or panic buying. But one can expect to be duly rewarded in the China markets if you are at the right end of the spectrum. And by now, it is common knowledge to the retail investors on the streets that some of these Chinese tech stocks are at a steal at the current price points. And I believe we are just 1 or 2 news catalysts away from the beginning of a new bull run once the FUD dissipates. While our portfolio year to date is slightly lower than the US indices, we believe we are well positioned going forward in terms of the risk to reward setup over the longer term. But till then, you have to have what we call strong hands, which means to say you have to be unfazed by the daily percentages. As long as you have done your research and due diligence to know which are the fundamentally strong companies to invest in, just hit the ground running as per the plan. In fact, such times are opportunities for our portfolio to grow by leaps and bounds. But as investors, we have to learn to manage our emotions and not throw in the towel. This is a rite of passage that seasoned investors will understand after they've gone through a few market crashes. And more importantly, it is about having a good methodology that can systematically grow your portfolio over time. In between, there can be ups and downs. Occasionally, bigger ups and bigger downs are going to happen along the way. But eventually, you must be better off. If you expect to have a portfolio with extremely little drawdowns during market crashes, it only means to say that during the bull markets, your portfolio is just going to be slightly better than stagnant as well. Undergoing market crashes is part of the game, especially for growth investors. For our Moneyball portfolio, if we just take a step back and look at the last 1 year performance from last year till now, we are still up by 36%, while the S&P 500 is slightly under 30%. And if we just take another step back to see, perhaps from after COVID crash of March 2020 to now, we are still up by about 150%, which is still about a net gain of more than 200k in our portfolio, even after taking into account of this horrendous sell-off from China stocks, which has also outperformed S&P 500 by more than double. This screenshot we grabbed it from IB, which is easier to see. So for those who use both IB and TD Ameritrade, you will know this. Well, for TD Ameritrade, we actually perform slightly better. So if you combine both IB and TD Ameritrade gains, this current China drawdown, while being unpleasant, it is still manageable in perspective. The lesson here is that today, if you want to be a true investor, you must be willing to take paper losses at a certain point in time. Billionaires lose millions while trying to make their billions, and millionaires lose thousands while trying to make millions. Only broke people want to lose nothing to become wealthy. For ourselves, while trying to build our 6-digit portfolio, we had 5-digit drawdowns before. And with a 7-digit portfolio, the drawdowns now become 6 figures. So for those of you who are growing your portfolio over time, this is what you will be facing and what you have to go through. This is a rite of passage. The problem only comes when you take a step back or take many steps back. And if you are still underwater, then it might be time to revisit your investment strategy. That means to say, you are already invested for about 3 or 5 years or more, and you still don't see meaningful results. So by giving you the bigger picture, I hope it can be reassuring to some of you, and to let you understand why we are not concerned when we see such drawdowns happening. Similarly, during the COVID crash last year, at a point in time, our portfolio was also easily down by about 25%, with the stocks and options positions that we are holding on. But eventually, it will recover if we are holding on to the right stocks with the right options strategy in place. You must have the expectation that occasionally something is not going to follow your plan, and that is normal. Just like the Delta variant doesn't follow our minister's script, neither does President Xi follow my investing plan. But that's okay, we deal with it and become better eventually. But if you ask me as an investor, other than having the right system or methodology, what is very important is also an investor's psychology. Do not crack under pressure. It is what you do during your break point that matters. There can seem to be many things ongoing at a point in time. The indiscriminate sell-off from the China markets on one front, and on the other side, we also have the US markets coming down as well. And then close to home in Singapore, things are just as bad with the COVID numbers. But it is how you pick yourself up that matters. Just like the show Money Heist, There can be many instances in our investment journey that will make you think if this is the end. But that's actually when it actually starts when you look back. Every bear market will lay the foundation for the next bull run. And while the China markets are down, we do not just do nothing and wait at the side. We tap on the opportunities in the US and Singapore markets to build up our portfolio. Part of good portfolio management is knowing how and when to ration your bullets so that during the recent declines in the US markets and the slow recovery in the Singapore markets, you still have room to take advantage of these opportunities. You never go all in into just one single market. While you may be overweight on a certain market, it should not be everything that you are invested in only. We share in both our private Moneyball Investors group chat for our students, as well as in our public Telegram chat channel on some of the trades that we did to ration our bullets. We also took advantage of the pullbacks in the US market to add onto some good stocks. For Abbott, we entered at 109 and exited somewhere at $121 to raise cash for other opportunities. We got near the bottom but not at the top, but that doesn't matter because the thing about investing is that you don't need exactly the top or the bottom to make good money. For some of our students who held Yum China on the same day, we also informed them that it would be ideal to take some profits, which itself eventually turned out to be near the top indeed back then. As a result of rationing our bullets, we were able to tap on to the opportunities to buy some of the stocks that were in consolidation. For example, for Boeing, we got in at 206 and we got out at 238. We then re-entered in early set at 212 and then we sold off at 227 to raise cash for other options assignment. Then for Amazon, we went in at 3,335 and 3,197 and exited at about 3.5k. We went back in at 3.2k in early October as prices hit the support level again. So despite Boeing and Amazon moving pretty much sideways since the beginning of this year, they are one of our top positions because we do not just simply buy and hold. The strategy to take depends on the market conditions and we deploy the appropriate moves under different market conditions. Also including many others like Estee Lauder, Lockheed Martin, as well as some of the good Singapore REITs. So the point here is that while some of your portfolio positions may not be doing well on one front like China, what we're trying to tell you here is that you got to keep up the fighting spirit and continue to fight the good fight elsewhere in US and in Singapore while buying time for things to pan out. This is what you have to do as an investor if you want to be successful. The wins in other markets will provide you with more safety and firepower to stay in a battle. So I'd like to end off this quarter update by saying that, especially for those invested in the China markets, what makes a great investor is what he does when the storm comes. You can choose to tuck away your portfolio performance till the sun comes out again, or you can choose to capitalize on the situation and continue the good fight to emerge even stronger after that. To be posted or kept up to date with our market outlook sharing sessions, do follow us on our public Telegram channel at the link below the video.